Hey everybody, it's Lisa and Bonnie with Moving Mountains Property Group. We're here today with Sabrina West from Guaranteed Rate, and we're going to discuss everything that has to do with mortgages. So Sabrina, I know that we have discussed many things about mortgages, but I know that you mentioned there were 4 principles of lending that you would like to discuss.
Start off with? Okay. Well, I always get the question of, what if, what makes up a mortgage? What do I need to have? So I always try to explain to people there's always 4 major principles of lending. One, the ability to repay, right? So where's your income coming from? How are you going to pay that bill? The second thing is credit history. Credit history tells us how you paid your bills into the past, and that gives us a good idea of how you're going to pay your bills into the future. The third thing is I call it skin in the game. You also know it as loan to value. How much down payment are you putting in? People who put little down payment into the process, a lot of times they have a tendency to not feel invested in it when things kind of go sideways. And the last thing is collateral. That means, is it a condo? Is it a manufactured home? Is it, a single family residence? Is it a multifamily? Those all have risk values. So lenders look at all 4 of those pieces, and you have to have all 4 of them in order for you to really get qualified. One doesn't really weigh more than the other. It's the balance of them all.
Okay. Another question that I get asked a lot that I would like to ask you is, and I'm sure you do too, is how is my mortgage rate determined?
Oh, I get this often. What is your rate? Give me your rate in points, and that's all I want to know.
3 point, no.
Exactly. Honestly, there's 4 to 5 components that play into that as well. So the main thing is credit score, right? So that goes back to that credit history that tells us, your credit score tells us how you're using your credit utilization and how you paid your bills, right? The second thing is loan to value, again, right? How much are you putting down? Okay. The third thing is occupancy type. Are you a primary residence? Are you a second home? Are you investment properties? Why does that matter? Because investors, sometimes if something goes sideways, like we said, then people are going to keep their primary residence and let go of that investment. The third thing is the property type. The fourth thing is the property type: condo, manufacturer, single family residence, multifamily. And then often a piece can play is debt to income. So if we're getting you qualified and you have a high debt to income, that can play into your rate as well.
So I have a quick question. Mm-hmm. So when we were in real estate school, many years ago, the ratios that they used for like housing, I think it was like 29% of your gross income would go towards your housing expense. And then 36% total debt would include housing and any other payments you have. Is that still kind of a rule of thumb, or is that depends on the loan?
It depends on the loan, and we use automated system now, right? Okay. So we use an automated system, and it kind of balances all of those factors, right? So if I have a lot of reserves, right, even though I might be putting a little bit down, I might be able to do it with a 50% debt to income ratio.
Okay.
So on average, a conventional loan, your total debt to income, you can go up to 50%. Most of the time, it's 43 to 50, right? If you have good credit scores, right? Lower credit scores, you're going to see that debt to income can't be as high. But if you're going to FHA, VA, any government insured loan, you can go up to 56% easy.
Oh, wow. Okay.
Yeah. Total debt.
Mm-hmm. So with all discussing this, it made me think of another thing that I would like to bring up. I think that whenever they're getting the rate, like let's say pre-qual letter, whenever they're getting a pre-qual letter, they can get a pre-qual letter correct without you going through their debt to income ratios and so on and so forth? Or is that just about, like the preliminary, is that just about the credit score?
Actually, that's a great question, and I kind of added it to that question list. So the difference between a pre-qualification letter and a pre-approval letter is 2 things. The major thing is the pre-qualification just means that you've given us your income, you've done an application, you've told us what your income and assets are, right? And we've pulled your credit. By law, technically, I can't say you have to give me all of your documentation in order for me to fully qualify you. So when you get a pre-qualification, it's like getting a credit card, offer in the mail, right? And I don't mean to discourage people, but it is, you need to really go to a level 2 pre-approval, meaning that your loan officer has looked at your income, looked at your assets. And that really means that we've kind of fine-tuned that, asked the right questions, and that is the difference.
Yeah, no, I think that's huge, because that, in essence, that's really what determines what price range you're going to be looking in. And I think it's more discouraging to think you're approved and not have done that, and then find a home that you really love, and then you end up finding out debt to ratio won't work, or one of the other factors may not work. So I think that's very important.
Well, the average consumer looks at it like this. This is how much money I'm making. That's all they think about. This is how much money I make. This is how much I bring in. We have to look at it of what's stable, that ability to repay. What is your stable income? Have you been making it for 2 years? Will it continue 3 years into the future? That's why bonus income over time, those have to be likely to continue, right? And you've had to have them on the average of 2 years. So people will fill out their application going, yeah, they think they're telling the truth, right? But by mortgage standards, it's different. So.
Right. Yeah. Okay. So once we get that rate, and they've got, and all of these things have happened and it's worked out, how long are they good for? People ask that a lot. Okay.
Yeah, it depends. You can lock in, with us, a guaranteed rate, you can lock all the way up for a full year if you need to.
Oh, wow.
Okay?
Wow.
We have a program called Lock and Build for new construction, where you can lock for a full year. And that we created that when rates were on that increase, so that people had secured low rates, right? But like you said, nothing comes for free.
Right.
Right. So sometimes you're going to find a little, if your market rate might be a little higher, but you can lock anywhere from 15, 30, 45, 60, 90, 180.
Wow.
So
I'm guessing you guys do offer construction loans then.
We do have a construction product, but you find, I like to do what I do and do it well, right? And so we have a construction product, but I think your local banks who are invested in the community do that construction product better.
Okay.
Honestly.
Thanks for that.
Yeah, I appreciate your honesty in that. It's awesome.
Try.
Oh, please. You're amazing. But
so a question I had is, what would cause your mortgage payment to go up? You close and you see on the closing statement, the closing disclosure, what your mortgage payment is going to be. What are some factors that would cause your mortgage payment to go up?
Well, right now, most people are doing a fixed rate. So your principal and interest are always going to be the same, right? But we can't control what happens with taxes. We also can't control if you go and decide to put personal property of $25,000 because you got a new ring or something on your insurance policy, and your insurance policy went up. So if you were escrowing, a lot of times people will see, well, why did my payment go up? Your principal and interest didn't go up on a fixed rate. But if those things change, then your payment's going to go up.
Yeah, because I get that question a lot from
me
people.
too.
And considering we just went through, I don't know if you all got your new tax assessment bill.
Oh, yeah.
But anybody escrowing in Buncombe County is probably going to be having theirs maybe go up this year. So.
I think that now there is an adjustable rate mortgage, right? So if you do go into what we call an ARM product, that means most of the time you have a fixed period. So you might have what's called a teaser rate. So it might start out at 3% for 5 years, and then it might adjust every year after that. So it has an adjustment cap, so it can only go up so much per year, and it has a lifetime cap. So those are the only other things. But most people know if they're going into that product, they're going to have that conversation.
Do you have many people doing those adjustable ARMs?
Jumbo loans do a lot of them. The reason is a lot of them retirees. They're really looking for a really low rate because they have big mortgages, and so they're going to reset that, or they're just going to take money out of their investments and pay those things down. So they're looking at their overall wealth and what that interest is.
Okay. So another question that we get is, how long after closing is it before your first mortgage payment is due?
Great question. So if, for example, if you closed in March, your first payment's going to be in May. Okay. So remember that you pay your mortgage in arrears. Okay. So if we close on the 15th of March, you're going to pay 15 days worth of interest on your closing disclosure, and then you're going to have 30 days of arrears. They're going to let that interest accrue, and then you're going to make your first payment. So typically about a month and a half.
So mortgages are always due on the first of the month.
Typically.
Right? Yeah.
You can change those sometimes when you get with your servicer, sometimes change, but you got to think it's all about billing, and they're not looking to do billing every day.
Me neither. Okay, so talking still kind of on the same subject as far as the credit scores, and what credit score do I need to get approved?
That's a really good question because I get that often, right? So you have conventional standards, USDA standards, FHA standards, and VA standards. So they put out kind of the guidelines, right, of what they will accept. But like FHA will say they will go down to 520, but it doesn't mean your lender will, right? So lenders have what we call overlay. So what they're saying is we're going to do FHA and VA loans, but due to limiting their risk to their portfolios, right, they're going to limit those. So like during COVID, you saw everyone go, people shot up to 680 and 640 for minimum credit scores. We went to 620. We're a very large company, so we have a little more risk capacity. But now they're coming back down. So for us, we're at a minimum of a 600 credit score right now. We were like on FHA, you could go down to, eventually we'll get back to those VA and FHA down to 580. We are seeing things loosen up now that we're seeing how many foreclosures are coming through due to COVID. So minimum is about 600, I would say.
And I would assume, or I know that the lower the credit score, the higher your rate, typically, correct?
Typically.
With your mortgage.
Typically.
So also talking about VA, FHA, USDA, could you explain to us maybe what is an FHA versus USDA and conventional?
So conventional, when you hear conventional, that means it is the government has laid out the guidelines, right? And so this is what was going to give you good insurability. This is where your risk factors are. But you can go up to a higher loan amount, right, to 548. So those are not insured, right, by the government. They're not a government insured entity, even though they set the guidelines. Does that make sense? But with FHA, VA, and USDA, FHA is done by the the U.S. Department of, I should know this, administration. So the Federal Housing Authority. So they're the ones who you do pay upfront premiums like mortgage insurance that's how they, provide the loan. But with USDA, that's done by agriculture, and those are rural loans. Did I explain that well?
Yeah. Because I know with USDA, we have those available around here, but you have to be like outside the city limits, because they are considered that rural loans.
An interesting thing about those in our area is there's pockets of West Asheville where I've done them before years ago.
Yeah.
I don't know if that would happen now, but like they had like little pockets. It was the strangest thing.
It's because we're growing so fast. Their maps really haven't caught up. So like you can literally be right at the beginning of Swannanoa, and that's all USDA.
Wow.
Interesting.
So going back to pre-qualification, and I think we already kind of answered this, but to be pre-qualified, the only documentation they have to provide is you'll pull their credit, correct?
Application and credit.
So if they were getting pre-approved, which is a step above, then they would be asked to require or to provide a lot of other documentation.
Typically, yes.
Okay. And another question that we get is how big of a down payment do you need to get a mortgage at this point?
Conventional, you can do as little as 3% down. Okay. VA, it's 100% loan. If you're looking at USDA, that's 100% loan, and FHA is 3.5% down.
Okay.
So Sabrina, another question that I get asked quite a bit is, what is the difference in a mortgage broker and if someone just goes to the bank to get a mortgage, such as Bank of America, First Citizens? I think people are not clear on what that difference is.
So a bank, you have a bank, and banks are FDIC approved. They're a depository institution, and they just kind of diversify how they make their money, right? They do car loans, CDs, mortgages. They're kind of all encompassing, checking, savings accounts, things of that sort. And then you have what's called a banker, right? Court guaranteed rate is a banker, right? So we actually lend with our money. So we're the actual mortgage lender, but that's all we do is mortgages. So we're 100% mortgage lender, and we do sell a portion of our loans on the secondary mortgage market, okay? A broker, they do what's called table funding. All they're doing is connecting the lender, the end lender, with the consumer, and they get paid a fee for it. Does that make sense?
Yep.
Yep.
Another question that I get asked whenever, let's say they get their first estimate, seeing what their payments are going to be, they want to know, what is mortgage insurance?
If you don't put
PMI.
20% down on your for down payment, you get what's called mortgage insurance. It's a fee that you pay the lender to be able to protect them in case you default. Okay. The good thing is mortgage insurance has evolved. Okay. So there's different types of mortgage insurance. You have monthly mortgage insurance. You have single premium mortgage insurance, which means that you're paying a lump sum fee to basically, you might pay a higher fee of $1,900, $2,000 to buy yourself out of mortgage insurance. Okay. And that makes a difference if you're staying in the property, right? Then you have what's called lender paid insurance. That means you're going to say, I have no monthly mortgage insurance, but I'm going to take a higher rate.
Right.
And then you have what's called split premium. That means you might pay a little upfront and you pay a monthly. And sometimes that helps with qualification.
That totally makes sense.
For FHA, I know at one point they were charging very high upfront premiums for mortgage insurance. Is that still the case?
Yeah. So they charge 1.75 on the upfront, and then it's 0.85 on the monthly. So that's how they fund
1.75 of the loan.
Of the loan. So what they do is USDA, VA, and FHA, government entities, charge you an upfront fee, but then they lend it to you.
Mm-hmm.
So they charge you the 1.75%, but then they roll it into your loan.
Oh, okay.
Just learn something.
Yeah.
Yeah, because
and then you have the monthly fee too. So what those fees do is they're high risk loans because they go lower loan, they're little down payment. They're typically will go lower credit scores. So those fees help with defaults and help fund the program, but it drives the rate down. That's why sometimes you would see that rates were lower on FHA, but right now that is not the case. And that's because there's more defaults on FHA. And so we're actually seeing the opposite right now.
Yeah, because I think first, like when the recession first ended, we were coming out of that, they weren't rolling those into loans. And then we were trying to get sellers to pay for these buyers' premiums because, sometimes it was like $7,000.
Yeah.
But it's good to know that they're rolling it into the mortgages now, because that in a multiple offer sellers market, there's no way you can get sellers to pay closing costs. It's rare if they do.
Yeah. And with FHA also, that PMI mortgage, the mortgage insurance, it stays on for the life of the loan, correct?
No,
it doesn't.
Typically 11 years.
11 years.
It used to be less. It used to be 5, and they jumped a couple of years. 4 years ago maybe. It goes to 11 years, and then it can drop off.
It can. Okay.
Yeah.
Okay. So the next question I had, we hear of like mortgage points and things like that. Can you explain to us what points are, and, do people need to buy these points down, or, whatever?
Mm-hmm. So points are upfront fees that you pay the lender for the loan. In that section 801 on their itemization, you have what's called set fixed fees, right? So you're going to see lender commitment fee. So for us, you see a lender commitment fee. You'll see like an application fee. For other lenders, you will see like credit report, flood certification, tax. Those all go into one section that end up being part of upfront costs to get you to that rate it is. Okay, so you have those upfront fixed fees, right, that we look at as points. But when you're talking about points, we're talking about discount points. When you're paying discount points, you're buying the rate down, right? Okay.
Right.
So it's different, right? So it used to be points were just part of origination and everybody paid them. And now when you pay points, you are paying usually to buy your rate down in some form or fashion, right? We didn't, for a long time, you didn't want people to pay points because they found out that it really wasn't effective for their mortgage, the payment difference. And sometimes it might cost, people were paying sometimes $2,000 and $3,000 to buy a rate down. And if you look at your recapture on that, your current questions is how long are you going to be in the house? Those kinds of things. Is this your property, a primary residence, a second home? When you look at points there, it's more beneficial because we're going to see closer spreads. I mean, today's rate, I could get a 30-year fixed at 2.625% with good credit scores, and I might pay 0.15%, not even a full point. Does that make sense?
Yeah.
So you do it more often right now because the spreads are closer than they've ever been.
So another question that I get, and I know that this is complicated, but people ask a lot, how quickly can they get a mortgage? How long does it take to get an actual mortgage?
Industry standard is 30 days, right? That's industry standard. Like I average about 22 days right now.
Whoa.
Boom.
Yeah.
So
even with COVID.
Yeah.
And it depends on your process. So I think if you get somebody pre-approved early in the process and you're doing a really good application. So if I always tell consumers, they're like, well, so-and-so just gave me a pre-qualification letter. And my question is did they ask you that? Well, so-and-so didn't tell me that. They didn't tell me that. They didn't ask that question. So a good loan officer is going to ask you the right questions to get to the right mortgage answers, not the answers we want to hear, but the right mortgage answers. And so for me, if you do a better application up front, it's a lot smoother process. I know you both probably encountered of like you're 3 days before closing and you're like, why are they not qualified? And that's typically because there's something that was not disclosed that we found through the documentation, but average is 30 days. But I mean, our goal as a company is to get down to 15 days, start to finish.
Wow.
Yeah. And there are people who are doing it. So
that's amazing. So I also have another question from someone that we all know and love, Robbie Sherrill, on Facebook. He wanted to know, is it smarter from an investment side of things to have several paid off mortgages and one large one, or several small mortgages? He also asked, write-offs are one thing, but what would save me more as an investor, pertaining to the first question?
Okay. Well, let's start with the first portion of it. Mortgages are not a one size fits all, right? Everybody's individuals. They all have different financial plans. Everybody's at a different stage in their life, right? So you really should, for an investor, you really got to customize that, right? So it depends. By Fannie Mae and Freddie Mac standards, you cannot have more than 10 finance properties, okay? So what I try to teach my investors is if you want to increase your buying power, when you're first starting off in investment properties, you want to, start off, and when you get to about 5, that's kind of my rule of personal thumb, is that when you get to a 5, then you might want to move it into a commercial umbrella loan, right? Because then you're going to encumber those into an LLC, and your risk factors are going to, because you want to take them out of your personal liability, okay? Because you cannot close in an LLC on investment properties.
Okay.
We used to be able to do that. We cannot do that anymore. That's why you're personally insured. The LLC might protect you for if somebody falls and gets hurt and things of that sort, but it's not going to protect you from the debt if you default. Okay. So it really depends on what their portfolio looks like. So I always try to say, make sure you're using your buying power, move into an umbrella loan once you get to a certain number. And then talk to a really good CPA. Okay, a good CPA. I can't give you, CPA advice, but they're going to help you figure out how to make sure that you're getting the biggest tax benefit, using your mortgage interest and depreciation properly, and those kinds of things.
Do you love doing investment loans? Is that something that you're into?
I do. I mean, I think it's one because I was an investor many, many years and moons ago. I learned a lot, and I did help a lot of people build their portfolios when I first started out in the business, because I was I was an underwriter, and I was a processor and an underwriter. So I started in on the backside. So I really got into the details and what I call using smart money. So I like working with investors and helping them build wealth in other ways, right? I believe that people have to diversify how they make money at this stage in life, right? Because the cost of living is so high. People don't stay in their mortgages for 30 years anymore.
Yeah, maybe we could have
That's a
you
good point.
back on as for just like a segment on investment. That would be really a good topic, I think, to talk about.
It was, because more and more people are getting into it.
Mhm.
Well, I try to
with the
teach people how to
entrepreneurship.
do, what we're encountering in this area particularly is that you have so-and-so who decided to put a house or a mobile home on the property, and they've been renting it out for extra money, and then you're trying to sell it. They list the property, they're trying to sell it, and you can't have 2 different lending types. You can't have 2 different property types. And so I try to talk to people about when they're listing properties, go ahead and make it subject to survey it off ahead of time, do 2 separate contracts, look at what your comps are going to be on your main home. You might pay this in cash. So it just helps you sell the property easier, because 90% of people, I know we have a lot of cash right now, but 90% of people need lending.
Right. And with interest rates so low, why would you not get a loan?
Yeah.
Cheap money.
Yeah.
Yeah.
So I guess a question that, we talked about a little bit before this segment was recasting loans. I had told you that I had clients that were looking to buy a house, needed to sell their house, but they were able to qualify to go ahead and buy that new home.
Mhm.
And then with the understanding they were going to sell their home after they closed. And so can you tell me a little bit about recasting your mortgage, if that's something that people can use as a tool to get into another home before they sell their home?
Yeah. Recasting is not guaranteed by any lender.
Okay.
Most servicers, right? So it depends if they sell 100% of their loans off their credit lines, or if they're a broker, because you can't determine what an end servicer is going to allow, right? We charge a $300 fee if it's a guaranteed rate serviced loan to recast. They have to make a minimum of 2 payments. It is very beneficial to lower that monthly payment. I do find that a lot of people are talking to their financial advisors more now and going, I have this rate here, I have the mortgage here. When am I going to recast, right? Am I going to give my money to my financial advisor, make more money in the market, and then recast in a year or recast So I think timing is huge, and making sure that you have really good professionals that help you with that.
Okay, thanks. That was good info. Were there any other questions you had, Lisa?
That was it.
So Sabrina, do you have like a favorite type of loan to do? First time buyers, jumbos?
I love all, right? I think I like teaching people how to use their mortgage for mortgage wealth. I mean, for overall wealth, right? So I think that's where so it doesn't matter that's a first-time home buyer. Sometimes first-time home buyer, I'm teaching them how to go, I need you to write down everything you spend. And then I need you to write everything that you make, right? Not your gross, what your net is. Because what we qualify people on is not going to be what people spend, right?
Mm-hmm.
So I really enjoy and I love the people in transition. I do work with a lot of divorcees as well too. I like kind of helping people through that traumatic time and setting their finances up so it's not a catastrophe and they call me 4 years later with a bankruptcy because their ex didn't pay what they were supposed to.
Right.
Mm-hmm.
So I think for me, I'm kind of a problem solver. I like to create solutions. Doesn't mean I want to do all creative solutions. That is not my niche product. But I just like asking people the right questions for them to give themselves their answer. For me, I'm just asking them the questions for them to figure out what direction they want, I don't tell anybody what to do.
No, you like helping people.
I do. Everybody learns differently. I learned by my mistakes. Even when I was in the mortgage industry, I still made mistakes. But I love helping people because I don't want people to make the mistakes I did. I was in the business 8 years before I bought my first home.
Yeah.
And then I bought a bunch of investment properties too.
All in.
Yeah.
All in.
Well, thank you so much for taking this time with us. And this information was really helpful. And I think it will help a lot of people, that have questions about mortgages. And, I think Lisa and I learned a few things today too that we
Definitely
did not know. So it's great. Thank you so much for
thank
taking
you.
the time.
Thank you for spending the morning with us, Sabrina.
Yeah. Thank you. Thanks for having me. Enjoy.
And we'll catch you guys next time on our next video. Hopefully Sabrina will come back and speak to us about investment loans and for anybody that's interested in getting into investment. So have a great day.
Bye.